Hello everyone, my name is Nick Odell and I will be presenting to you the ZBest accounting scandal today. So we begin with the company. So it began in fall of 1982 as a door-to-door carpet cleaner. From 1984 to 1987, their net income went from less than $200,000 to more than $5 million. It went public in 1986, and by spring of 1987, the market value was over $200 million. By July of 1987, fraud had been revealed and the assets were valued at only $62,000. So the mastermind behind all of this was 16-year-old Barry Minko. He was a very extroverted, smart, charismatic young man, and he had mottos such as think big, be big, and the sky is the limit. So when he went public with the company, he really fooled the SEC, created a bunch of documents, and was able to make all of his revenues seem legit. So in the end, he was convicted of 57 counts of securities fraud and sentenced to 25 years in prison. So the plan. Beginning early in the life of ZBest, he really was having some financial problems. He was unable to get banks to give him loans. He did not really have very much revenue coming in, so he used a lot of creative financing methods, such as check kiting, credit card forgeries, and staging thefts to fleece his insurance company. So to really expand his fraud, he figured he needed to create an extensive social network. So he did this through the LA Health Club. The first person that he came in contact with was Todd Paget, who worked for an insurance company. And he paid Todd $100 every week to confirm that ZBest got occasional insurance contracts in case anyone had ever called. So these phony insurance contracts were then used to create revenue, and this revenue was then used to convince bankers to loan money to ZBest, and the fraud continued. So once Minko found out that he could basically make the extent of this fraud however large he wanted to, he really moved from the carpet cleaning business to full-time insurance fraud. So he used these fake financial statements to entice wealthy individuals to buy in as well. So his next step of the plan was to go public. So once he went public, he knew that he would not be able to control the financial disclosures anymore. So the first auditor he hired was George Greenspan. So Greenspan claimed that he had done a full audit on Minko's company. He said that he did examine the analytical procedures as well as looked at the key financial ratios and compared them with industry norms, reviewed copies of all key documents pertaining to these insurance contracts, and even contacted Paget about these insurance contracts. However, what he did not do was physically visit any of the restoration sites. So that's sends up a red flag, and is obviously a step that he should have taken during this audit, which would have saved lots of people a lot of money. So after a year, Greenspan had completed his audit, and Minko decided to hire a larger accounting firm to complete the next audit. So the second auditor was Ernst & Winnie, and between the first and the second auditor, there was not very much good communication, so Greenspan did not communicate his possible problems with the financial statements or anything like that. So Ernst & Winnie never actually completed a full audit and never gave an unqualified opinion because they believed there was way too many areas of financial fraud in the financial statements. So one of the ways that they kind of discovered this was they required Minko to actually show them one of these restoration sites. And so what Minko did, and this was really the most extensive part of his fraud, was he created he made the top two floors of a building look like they were under an insurance contract for them, basically decked it out in ZZBest stuff, hired some people to go there and say they'd seen them all the time and other things like this. So he brought the auditors up to make it all legit and to get on to the next part of the audit. So the really fishy part about all of this was he made them sign a confidentiality agreement, which required them not to recontact any of the people that they had seen there today, not to come back to the scene, not to do anything like that. So obviously this, again, sends up a huge red flag, because as an auditor, you have to have a professional skepticism, and if someone is telling you that you're not allowed to come back here, you're not allowed to talk about it, you're not allowed to do pretty much anything regarding it, it clearly should send up a red flag and should tell you that there are some fraudulent activities going on. So the results. So Ernst & Whinney ended up refusing to give an audit opinion. However, they did not share their shareholdings with, or they did not share their findings with the shareholders. So Minko's fraud was actually discovered kind of through the press from his past credit card forgeries and things he had done when he was younger after somebody wrote about it in the newspaper. And so the really big kicker was he had the small couple $100 that he had owed to somebody way back in the past, and they pursued this and really tried to show all the people that he had screwed over in the past, and this really kind of unveiled the fraud, and everything went down from there. So he ended up being released from prison in 1994. He became a pastor and has constantly lectured about his experience with corporate fraud. However, in 2009 and 2014, he performed 2 more frauds, which he ended up being convicted of as well. So really, this case really shows a lot of different things, but what I really took out of it was the importance of audit evidence and third-party confirmation. So just kind of conclusion. So some of the problems that happened in this was obviously the miscommunication between the former and the current auditors. You really need to have good communication, and so that the new auditors can come in and not have to start from zero, start from nothing, but rather have a starting point and can kind of find the areas that they believe are more likely to have fraud. So additionally with this is because of the insurance contracts were 90% of the revenue and there was no actual physical inspection of any of these insurance sites. That also really throws up a big red flag. And then for the first auditor, there was no due diligence. He didn't go visit the sites. He didn't do anything like that. So that was a big problem. And then no professional skepticism. So this really applies to both the first and the second auditors, because they just kind of took what Minko said without a grain of salt. And you really have to do your own research and find out on your own whether the things that they are saying are true or not. So thank you. That is my presentation.